most of us also learned that FIIs actually don't matter.
Extent of dependence on foreign flows have reduced, but we should not be complacent and say that we don't need them. We do need them.
Return expectation should one keep in.
Our view is that large caps can give you 10-12% return, maybe 12-13. The broader markets can give you 14-15%.
Which three sectors do you think will surprise investors?
Export opportunity.
India's export sector,
export businesses.
Because a lot of companies in the Euro region particularly are becoming non-competitive.
Which three sectors you think may disappoint?
We are significantly underweight or almost zero weight in staples, the consumer staple.
What would be that headline you would give to the upcoming year?
Corporate profit growth.
Hello and welcome to the Beyond Returns podcast by ET Money. So our guest today is someone who has shaped some of the biggest investing success stories in India. He is the founder of Abakkus Asset Manager, a reputed and well-known boutique investment management firm that manages over rupees 38,000 crore. But long before Abakkus, Sunil made his mark as the CIO equity at Reliance Mutual Fund. Over there, he managed Reliance Growth Fund, which was one of the consistent performers and a huge wealth creator for investors. He has now entered the mutual fund business, enabling retail investors to benefit from his expertise. Hello and welcome to the show, Sunil. So glad you could join us.
Thank you.
Before we start talking about the year ahead, let's discuss one lesson that you learned from 2025 as an investor or money manager.
Lessons are always learned, but I would say in 25 it was patience pays.
Okay, and I mean, why do you say so?
And it's been a tough year, full of uncertainty, lot of news flows, lot of events, slowdown in economy, and then obviously there's some optimism, multiple wars, with India, Pakistan also, tariff issue, always on, off. So I think in all these uncertainty, one had to be patient, And I think right now, being patient is helping because markets are slowly sort of finding their bearing.
True. I think one trend that everybody spoke about in 2025 was also about FIIs taking money out of India, right? Most of us also learned that FIIs actually don't matter as much as we thought they did, right? How closely were you watching this trend?
Also, I think FIC do matter, obviously. Obviously, the intensity or the extent to which they matter has been going down slowly, largely because the domestic flows have been a great sort of a counter to that. Having said that, I think for Indian economy to grow, we need external capital. And also to absorb the fresh supply, it is always good if you have long-term investors, both domestic as well as global, pitching in. So right now it's been only the domestic investors which are firing. Hopefully, we'll have a change and global investors will also start to be positive. But I would say, yes, the extent of dependence on foreign flows have reduced. But we should not be complacent and say that we don't need them. We do need them.
True. One last question about 2025. So let's say if you can rewind the clock to the start of 2025, right? What is that one thing you would regret missing in that year, which you would change if you had a chance?
Oh, it's very difficult because in hindsight, it's very easy, right? But I think 25 also heralded that, the $4 trillion to $8 trillion economy which we are heading to will be contributed by a few new sectors and stocks. And because we are value-conscious conservative investors, I would say some of the new age stocks, in hindsight, we feel that we should have looked at more closely.
Oh, okay. Now, let's talk about the year ahead, the main theme of this podcast. And let me start with the broad question first. So, market ka kya lagta hai? And I know you're an optimist, but I would also urge you to cover some risk that we can possibly face in the year ahead.
No, so I think, as you rightly said, we have always been optimistic last 25, 30 years, and that's paid because, despite all the ups and downs, ultimately, we have seen the returns being made by investors. As we move forward, I think there is optimism. Obviously, last 1 year returns have not been great. We are looking at single-digit kind of returns. But it has also been a period of a lot of uncertainty, which we talked about earlier. Multiple small wars, a lot of ups and downs. Indian economy did slow down because of the election year. In election, everything slows down. Corporate profit growth was very muted. But I think now there is optimism also. RBI has been firing, a lot of liquidity push. Interest rates have been cut. Maybe one more interest rates might be cut. Government has been firing. You've had an income tax cut, you've had a GST cut. And now there is also talk of tariff issue very near to being resolved, though it's not being. There's a slip between the cup and the lip. So let's hope that. So I think in all that thing, we are seeing now earnings growth also picking up. So September earnings growth was pretty decent. After a long time, we had a double-digit earnings growth, though on the lower double-digit side. But our view is that the second half of financial year 26 and the year of 27 should be a year where earnings finally look at moving up like by 15% plus. And that's why we sincerely believe that, market acha lagta hai. And I think among all asset classes, equity stands out as I would say one which can give you 14-15% kind of returns.
So you mentioned about the earning trajectory already. Now, based on the earning trajectory, I would like to know what kind of return expectation should one keep in the year ahead at least?
No, I mentioned to you, I think what we are looking at is 6.5 to 7% of real GDP growth. Inflation has come down. So, even if you take 3.5% of inflation, we're looking at like 10% nominal GDP growth. Our view is that large caps can give you 10-12% return, maybe 12-13. The broader markets can give you 14-15%. And this is without factoring in any uptick in P multiples, because P multiples though not very expensive are not very cheap either. So our view is that if corporate profit growth can be 14-15% over the next 3, 4, 5 years compounding, I think equity markets can give you those kind of returns.
Okay, got it. So if I look at overall across different segments, right, where do you see more value now? Do you see more value in large cap, mid cap and small cap segment?
Actually, this is a very oft discussed, debated sort of a topic, that large cap karoon, mid cap karoon, small cap karoon. But see, ultimately, equity investing is becoming a partner in the business. And now you'll want to become a partner in the business where the outlook is great and the valuation you're paying right now leaves some room for upside. So I would say that irrespective of large, mid or small, where in whatever companies there is value and there is growth, I think those will do well. Having said that, by nature, larger companies are like elephants. They will be very stable, but they will move slowly. And the broader markets, which is mid and small cap, they will be a little bit more nimble. They are, owner-driven companies in segments which are growing faster, but they will be more volatile. So I would still say that if an investor is willing to bear the volatility, the mid and small cap will do maybe 2-3% better than the large caps.
I agree that it's a debatable topic, but the only reason I asked you was because until last year, right, where the valuations of mid and small caps were really high, there was this general talk about how they are very expensive and there's value only in large caps. So that was the only rationale for asking you that question.
Now, what happens, one comes to a conclusion looking at the P multiples at the index level. But the index level P multiples might not be the right way of looking at it. So even in large caps, you have companies which are trading at 50, 80, 100 P multiples. And then you have companies which are trading at 10, 12 P multiples. The same will be the case in the mid and small cap. And mid and small cap investing is all about stock picking. So one has to be actually, focusing more on individual stocks rather than the index level P to come to any kind of conclusion.
Got it. You also spoke about GDP growth, right? Now, this is something I just wanted to understand. Just get your view quickly. Now, if we see the GDP growth, at least last quarter or sometimes even in the previous quarters, right, it doesn't seem to reflect the stock market reality. So if I look at the trends in sales of car, two-wheelers, tractors, and so on and so forth, many economists fear that the growth numbers, right, will not be the usual 6 to 7% in terms of growth that we saw the GDP growth, comparatively, right? So, but Q1 number of our GDP was close to 8%. Now, I just wanted to understand, as a market participant, right? How do you view this number and how do you use it? How do you view it or use it while you are actually investing?
So one is this Q1 number of 7.8 should not be taken as the yearly number. We are working more with 6.5 to 6.7% for the entire year. And I think that is achievable. The second thing is GDP constitutes a lot of things, including services, including exports, including, agriculture, and then obviously the listed plays. Also government spending and all. So there will always be a mismatch in the near term between what the GDP is reporting and what is actually being felt. Having said that, ultimately it has to converge. Some products might grow faster than the GDP, some might grow slower than the GDP. But as a basket, you will start to see this converging. The other thing we have to realize is that, particularly on the consumption side, there are a lot of unlisted companies which are chugging or taking away some market share. So when you mention about cars or two-wheelers or, soaps and shampoos, it is possible that 1, 2, 3% growth is being accounted for companies which are not listed. And therefore, if I don't think soaps and shampoos are growing at only 1%, which is reported by the largest FMCG companies. But now there are so many D2C brands which are taking away small percentage stakes. Same is the case with passenger vehicles. There have been so many new entrants and not all of them are listed.
Hi. Before we continue with the conversation, there was one thing I wanted to discuss with you. So more than half of you who are listening to this conversation have not subscribed to the channel. If you like the work that we are doing, then please consider subscribing, because this will help us to get more such industry veterans to this platform to share their knowledge and wisdom with you all. Thanks, and now back to the show. So you mentioned about the D2C brand, which brings me to one question about sectors. So which 3 sectors do you think will surprise investors in 2026? And which 3 sectors you think would disappoint? And if you can just give 1 or 2 lines rationale about each one of them.
So I think financials, we are very positive. But financials will not be only the traditional banks or the lending NBFCs. Financials now are the non-lending financials also, like asset management companies, wealth management companies, insurance companies, capital market companies, a few fintech companies. I think they're all part of financials. There, we continue to believe that there is huge potential. I think engineering also has good potential, particularly, specialized engineering. It has both, I would say, more potential from a domestic perspective, because, this whole Make in India, including defense, manufacturing, EMS, railways, they're all huge opportunities. And there is also an export opportunity, because a lot of companies in the Euro region particularly are becoming non-competitive. And we are seeing Indian companies getting some advantage of it. Obviously, this tariff thing has come as a little bit of a near-term roadblock, because, exports to US have slowed down with this 50% tariff. But I think we're talking about a natural scenario or normal scenario, and there we do believe that. I think even in pharma, we are quite optimistic. And as I said earlier, we are value-conscious investors. We have not looked at new age companies, but I think it's a matter of time we have to look at it, because, our own internal way of working and spending has completely changed, and, it's become an integral part of our day-to-day lives.
True. And which 3 sectors you think may disappoint?
So we are underweight oil and gas, regulated sector. We are significantly underweight or almost zero weight in staples, the consumer staples, which I mentioned earlier, because the growth rate is so low and still the PE multiples are 50, 55. I think at some point of time, even now, we are significantly underweight IT services. And we would prefer maybe a product company or a R&D company or some new age companies over the traditional IT services companies.
In fact, we spoke about consumption twice, right, in both the previous 2 questions. Now, I remember I started my career in 2004, right? Since then, I've been hearing about India being a consumption story. And in the past 21 years, I haven't seen that played out as it was touted. Now, off late, we have seen how D2C players have taken markets away from the traditional players. I just want you to help me make sense.
I don't agree, because I think each one of us should look at our own habits. 25, 30 years back, we used to buy maybe 3, 4 shirts in a year. I don't think, anyone buys less than 15, 20 at least, if not more. And now we have, different attire for different day of the, different times of the day and different occasions. So morning we have athleisure and then gym leisure and then office attire and then weekend attire and wedding attire and party attire. So I think consumption has increased. The number of cars sold, the number of two-wheelers sold have dramatically increased. The number of hotel rooms have dramatically increased. The number of flights each one of us take and cumulatively we take has dramatically increased. Number of airports have doubled from 75 to 150. So I think consumption has definitely increased. I don't agree with that. And I would say that going forward also we'll have a gradual increase in consumption. The only thing we have to realize is that we are a large economy. And even now we are a relatively poor economy. So as the standard of living improves, I think consumption will only strengthen. Because the initial amount of what we make goes into roti, kapda and makan. It is only after we cross that heat or hurdle, we start to focus on some kind of comfort or wants rather than needs. And I think more and more Indians are moving into that want kind of category away from the need kind of category.
Got it. In fact, from what you said, one thing that I realize is people look at consumption only in terms of FMCG or select few categories, but it has to be looked at a very broader way. And so you mentioned sectors that you are overweight on, right? But are there themes that could be exciting that you're studying and maybe not have made up your mind about them right now?
So the new age companies I mentioned earlier, see, the only thing we do is we don't invest in loss-making companies. Because our view is that the company should have reached a stage where even without raising new capital, they are able to survive and grow. So that is the only criteria. But I think new age companies are here to stay. There have been multiple examples, like, the online broking companies. They have grown from nowhere. In 5-7 years, they are among the largest. And same is the case with so many other companies. They have all become integral part of our lives, and we don't even have to ask anyone. Every day there are some parcels which are delivered. Every day we eat food which is delivered. Every day we order something, online. So I think there is a lot of changes which has happened. I think the whole way we pay is completely changed. You don't need to have a wallet in your pocket now. पहले छुट्टी के लिए झगड़ा होता था रिक्शे से 1-2 रुपए के लिए, वो सब बंद हो गया because we have. So I think all these are new age businesses where you have to have oversight. As I said, we are value conscious. So far, we have not been very, very aggressive in that. But, these are sectors where you have to have an eye on.
In fact, talking about new age businesses, right? Maybe about a year or two back, there was a lot of criticism or a lot of discussion, if not criticism, that Nifty 50 or Nifty 100, they don't reflect the true changing consumer trends because a lot of services that we were using like Amazon, Flipkart, and so on and so forth, Zomato, they were not there in the space. Now with new age companies slowly coming in, do you think we will see like a true picture of our changing consumer trend, at least in Nifty 100?
It's early days. Companies are getting listed and some good companies are getting listed. We will not get into the valuation part, whether the valuation is cheap or expensive. That is for the buyer and seller to decide. But I think some very interesting businesses have already got listed and more will get listed. So I think it's an evolution. It always happens. Ultimately, the markets and the indices will reflect in some way, the constitution of or the composition of the economy.
So I know you said you don't invest in loss-making companies, and a lot of IPOs that we have seen of late have been of loss-making companies, and you're also not an investment banker. But just wanted to know if you can give viewers some sense of the IPO pipeline, given how the market is behaving right now. Do you think the pipeline of IPO will continue to remain strong in 2026?
I think there's more than enough in the pipeline, and that is what is holding back the market because supply is so strong. I think pipeline is huge, and IPOs come in surges. So now we are at the end of the result season. Towards the end of December, you will again have a surge of of IPOs. It always happens towards the end of the quarter. And, a lot of IPOs are in the pipeline. In fact, whoever you meet, whether it's an SME IPO or a main board IPO, I think there's so many known guys who are planning an IPO.
Got it. So we've talked about sectors, right? But I wanted to dig a bit more there. And it's not possible that we keep discussing about each and every sector, right? So we'll do quick take, right? I will name a sector which we have not discussed yet. You can just say bull, bear, or just simply pass. Okay. So auto,
Pass.
banks and NBFCs,
Positive.
chemicals,
Positive.
commodities,
They are cyclical, so on and off positive.
okay. You mentioned you mentioned pharma, but what about healthcare overall? Because we have hospitals also.
Now, pharma positive, healthcare segment is positive, valuation negative.
Okay. PSUs?
PSU banks positive.
Okay. What about other PSUs except for
Again, differing. I think some defense PSUs are doing fine, other PSUs I'm not very sure.
In fact, my next sector was defense.
Defense, great sector, valuation-wise negative.
And just one word again, though we have discussed, platform and other new age businesses.
Positive if profit means.
Okay. So last two questions. Now, if you have to describe, right, 2026 basis of the conversation that we've had and the trends that you have witnessed so far in a newspaper headline, right? So as a market participant, what would be that headline you would give to the upcoming year?
Corporate profit growth 17%.
And my final question is, now we've discussed forecast, we've discussed trend. What's the forecast about Abakkus Mutual Fund, right? We've heard that you are going to launch it. Will we see the launch in 2026 so that retail investors benefit out of your skills and expertise?
Well, you'll see a launch in 25 itself. You don't have to wait till 26.
Oh, wow.
We'll
Congratulations.
launch our first fund hopefully in December. We're just waiting for regulatory approval. We will try to do our best. See, there are only 50 mutual funds in the country. And actually, if you see the equity AUM on the actively managed funds, is almost 40 lakh crores. And top 20 asset managers would have 90% market share. So technically, it's 20 mutual funds of relevance, or 25 we can take it. I think there is space for more, because this 45 lakh crores will also double to maybe 90 lakh crores in the next 4-5 years. So if you perform well, I think it has to be always investors first. So if you're able to do justice to the investors, there is no reason why we cannot be a relevant place. We don't have ambition to be the top because we're just starting after 30 years of others. So we are in our first lap. But we will at least like to run.
No, I think with your kind of experience, like you've said in a lot of previous podcasts also, right, that when you started Reliance, it was the last player, right? And the way it has grown. So I think investors chase returns. That's the reality. And with your expertise and your guidance, I think we would definitely see Abakkus in the top 10 at least.
Thanks a lot. Your wishes mean a lot.
Thank you so much for joining us on the podcast. It was really a pleasure talking to you.
Thanks a lot for having me, and wishing you, your team, and all the viewers of ET Money a great 2026. We are very confident, and we wish that 26 brings in the kind of equity returns which all of you have been waiting for. I think 25 has been a tough year, but the good thing is that we have not ended with losses. We have ended with small gains, and we are very hopeful that 26 will be the year which will bring a lot of smiles and wealth to all of you. Happy New Year.
Thank you, and we hope what you said comes out to be true. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.